It's an exciting moment for content creators when their channels start to generate substantial income. Suddenly, the questions start to pile up. How do I handle taxes? When can I go full-time? And the topic of this video, how do I actually pay myself as a content creator? How should you actually manage your income, your taxes, and your business expenses without creating a huge mess or becoming completely overwhelmed? In this video, I'm breaking down exactly how to pay yourself as a content creator, whether you are a sole proprietor, running an LLC, or operating as an S-Corp. We'll cover some tips and tricks on how to protect your finances, save for taxes, and manage your business with irregular cash flow. But before we do that, we have to kick off with a disclaimer. This video provides general financial education and is not personalized investment, legal, accounting, or other advice, nor is it a solicitation for advisory services. Please consult a qualified professional for advice tailored to your specific financial situation. With that out of the way, let's get started. The most important thing whenever it comes to withdrawing from your channel is to be intentional. Being intentional with how you withdraw from your channel does three primary things. It protects you legally and financially by separating your business and your personal funds. It helps you save for taxes and retirement so that you're not scrambling at the end of the year or neglecting your future. And creating a plan gives you clarity and confidence so that you can focus on what you want to do, creating, not stressing over the monetary aspect. All right, so how does this actually work? If you are a sole proprietor or a single member LLC without an S-Corp election, the process is really straightforward. You pay yourself through an owner's draw. This means that you transfer money from your business account to your personal accounts as needed. You don't have to run payroll, you don't issue yourself a W-2, but you do have to pay self-employment taxes. Self-employment taxes are really just Medicare and Social Security, and they amount to 15.3%. And since you don't have an employer running payroll for you, and you're not issuing a W-2, your taxes are not automatically withheld. And since taxes aren't automatically withheld, you have to save for quarterly estimated tax filings to the IRS. Before we go any further, if the terms LLC, S-Corp, sole proprietor, if those are all new to you, I actually created a video breaking down these terms, breaking down the different types of legal entities that applied most to content creators. If you're interested in learning more about that topic and trying to determine which legal entity might be best for you, I'll leave a link in the description. Now, on the topic of taxes, when you're just starting out, a good rule of thumb is to set aside 30% of your revenue for taxes itself. The purpose of this is so that each quarter you don't have a surprise tax bill. Whenever you actually file your estimated tax filings to the IRS, you already have that money set aside. Without getting too much in the weeds, if you're operating in a single member LLC, it by default is taxed like a sole proprietorship. This means that all of the revenue and expenses from the business go to your personal tax return. If you are operating as an LLC, you can elect to be taxed like an S-Corp. Now, there are some rules about when you can actually make this election. Consult with a tax professional to be able to walk you through that. If you do elect as an LLC to be taxed as an S-Corp, or if you are operating as an S-Corp, then it does change the taxation and payment structure. For S-Corps or LLCs that are electing to be taxed as S-Corps, then the payment structure gets a little bit more formal. The primary difference here is that you actually have to run payroll for yourself. This also means that you have to withhold taxes for each check, and any additional income that you take beyond a reasonable salary is taken home as a distribution. Think of your income as two different buckets. You have one bucket, which is your salary bucket. You end up paying your federal, state income taxes. You have your Social Security, Medicare that comes out of each check. And then you have your other bucket, which is distributions or excess profits that you can take home as an owner of the business. On this distribution bucket, you don't actually have to pay self-employment tax. So you're actually saving that 15.3% on distributions versus the amount that you're paying in salary. For example, if your business earns $100,000, you might pay yourself a $60,000 salary and take $40,000 as distributions. On the $60,000 salary component, you still have to pay the self-employment tax. On the $40,000 that you're taking home as distributions, you don't. An important thing to remember here is that the IRS requires S-Corp owners to pay themselves a reasonable salary based on industry standards. If you skip this component, then if you're audited by the IRS, then you run the risk of having to pay fines and penalties to the IRS if you did not set yourself a reasonable salary. At a certain income level, this makes a lot of sense. You could potentially save thousands of dollars on self-employment taxes by electing S-Corp status. However, you have to balance that with the added complexity. This adds additional cost and complexity, having to have a payroll provider or paying somebody to run payroll for you. So the big determining factor here is whether your income is high enough that you would actually save a substantial amount of money on self-employment taxes that it would make sense to opt for S-Corp status versus a pass-through entity like a sole proprietorship or LLC. So then the next question is, how much do you actually pay yourself? Whenever you begin to see that income, it's natural to want to take some of that home. And I totally get it. Many content creators are working for months or even years before they're generating substantial income. And so whenever they see it, it's a natural tendency to want to bring that home. However, I would caution you a little bit on that. So to answer this question, here's a flexible framework that I like to use with my clients to help them think through what it means to manage irregular cash flow. The first bucket is taxes. A good rule of thumb is that for every dollar that you take home, you need to set aside 30% of it for taxes. This will help cover federal, state, and self-employment taxes as well. Now, obviously, every situation is different. If you're electing for S-Corp status, then the amount that you need to take home is largely dependent on your income, but that's a little bit too deep in the weeds for this video. The second bucket is owner's pay. I like to think of this as taking home 30 to 50%. Now, this is how much that you actually bring home as the creator as your income. The third bucket is operating expenses. You all have gear, you have software, you have people that help you edit videos, anybody else that's on payroll, any software that you use, any tools, websites, things like that. All of those operating expenses need to be accounted for, and setting aside 10 to 15% for those things is generally a good rule of thumb. And then the last bucket is savings. So as a content creator, I highly recommend setting aside part of your revenue for savings. This could be saving up for additional gear or for a collab or for plane tickets and lodging to go to certain events. It's always prudent to have a separate stack of cash for being able to invest in gear or to go to events or having an unexpected expense within your business. Think of this like savings that you can either reinvest into your business or to use as a cash buffer for low income months. These are just general guidelines. Every single situation, every content creator is different, and these percentages will change based on the income level that you are as a content creator. It's helpful to work with a professional who can help guide you in what is a prudent amount to save, invest, and take home, and how to actually structure all of these things properly. Let's break these buckets down into a simple example. If your channel made $100,000 last year, then for the taxes bucket, you should save $30,000. For the owner's pay, you could set aside $40,000 to $50,000. For operating expenses, that 10 to 15% would be 10 to 15 grand. And then the profit, savings, cash buffer, whatever you want to call this bucket, would be $10,000 to $20,000. And again, these percentages are just a starting point. If you have a very high capitally intensive business, let's say that you're constantly flying in guests for podcast interviews, then you might need to allocate a heavier percentage to the operating expenses bucket than another content creator that mostly creates content by themselves. If you have higher or lower operating costs or higher or lower gear costs, for example, then your percentages could change according to your specific channel, the way that you create content and your needs. Now, this can get a little bit messy to maintain if you're just putting all of your income into a checking account and trying to prioritize or keep these buckets separate within a single account. To keep this clean and easier to maintain, I recommend using a business banking account that allows you to create sub-accounts. This will allow you to actually create a separate account for the buffer. Think of sub-accounts as the containers for the different buckets that we classified above. So you would have an operating expenses bucket, you would have a savings and cash buffer bucket, you would have an operating expenses bucket, a tax bucket, etc. Then whenever the income actually hits your account, then you would just separate them into the separate buckets according to the percentages that you've allocated for yourself. And then again, to try to keep this structured, you could pay yourself from the owner's pay bucket on a weekly, bi-monthly, monthly cadence, whatever cadence is most comfortable for you. But I do recommend trying to keep this a little bit more structured just to help you personally know whenever you're going to get paid or when distributions occur, and also to be able to help with the cash flow management of your business account itself. One note on the owner's pay bucket is that I do recommend using it as an income smoothing account. Content creators have notoriously variable income, meaning some months that might be lower in income, some months might be higher. Now, in order to keep your income consistent across all of those months, then it's helpful to have a cash buffer within that account. Think 2 to 3 months worth of your income in the accounts versus drawing it all at once. That way, if you have a month that is lower in income, then you can still withdraw the same amount. And if the next month is higher in income, then you replenish that amount. This helps you to be able to smooth out your personal income while also keeping a consistent amount in the bank account to be able to smooth over those variable months. We can talk more about smoothing out your income in another video if that would be helpful. The main point that I want to get across in this video is just to be intentional about how you pay for yourself and build systems and processes to make it easy on yourself to be able to operate your business. Obviously, there's a lot that goes into this, especially as your income continues to grow. It can be helpful to work with a professional who understands your lifestyle, your business, the variable nature, and the complexities and nuances of creating content in those businesses. If you found this video at all helpful, I would genuinely appreciate a like on the video and subscribe if you want to see more content like it. Otherwise, I'll see you in the next video.